Hi, I wanted to make a quick explainer for essential question number 4, version 3 in spring of 2011. This one is intended to be the simple purchase and sale of an asset with a gains tax. So what I said is that you're going to get a vroom, which like some kind of Dr. Seuss thing. It's going to cost you $10,000 in year 1. You anticipate selling the asset in year 3 for 8. So I've set it up so that you have cost basis, and you're also going to have some kind of salvage value in there. And I've given you a tax rate of 40% and a minimum acceptable rate of return of 20. So you know what's going to go on here is that you're going to have some depreciation, and you're going to have gains tax, and that's what we're going to be showing in the income and cash flow statement. So no subsidiary calculations in order to get any of this done. We didn't mention anything about increases, decreases in operating expenses or operating revenue, so those are zeros in all these years. We didn't take out a loan, so there's no interest. The only thing we have to worry about is depreciation, and that's where that table comes into play. We bought something which is $10,000, and if we told you it was a 5-year asset, so the first year you own it, your depreciation is 10,000 times 0.2, so that's that first number in the table. The second year it's $10,000 times 0.32, and the third year, because we're selling it, is $10,000 times 0.192 divided by 2, because in the year you sell it, you only get half the depreciation you're due. So if you look back over here, we've got the $2,000 worth of depreciation, the $3,200, and then half of that year 3 depreciation. And please note that the sign convention here is that the depreciation you have is a positive number. It's not a negative number. And this is key. If you put in a negative number for depreciation, people aren't going to understand what that means. Anyway, your taxable income ends up being operating revenue, less all the expenses, or just negative $2,000, $3,200, and $960 in each of those 3 years. Easy. The negative number means that your taxable income's gone down, so you expect to see lower taxes. And these negative numbers on the taxes mean that the taxes for your firm is going down because of this purchase that you're making of an asset. So, first year all I've done is I've taken your taxable income and I've multiplied it by that combined tax rate, and I've done that for each of the other years. What's left over is your net income. Now, carry the net income down, and so it's exactly what the number above are, and go ahead and grab your depreciation from up above and also put that in the cash flow statement. So except for that little bit of calculation that you got to make about depreciation, lots of things going on here are just a couple of subtractions and then copying. Now here comes the complicated part. The complicated part comes in the investment section of the cash flow statement. The two things you have to worry about are the purchase and sale of the asset, and then finally figuring out what the gains tax is supposed to be. So the purchase is easy because you are buying an asset, so cash is flowing out, so that's a negative number equal to the purchase price of the asset. And when you sell the asset, that's cash flowing in equal to what you sold it for. Easy. The complicated part ends up being the gains tax, because what you have to realize is that you took, what was it again? $2,000 plus $3,200 plus $9,600 worth of depreciation. Well, that's $6,160 worth of depreciation, but then you sold it for $8,000. So you didn't sell it for its book value. You sold it for more than its book value, and the idea is you're supposed to pay those taxes back. Well, what this formula does right there is it takes its cost basis, subtracts off all the depreciation, says here's what the book value is, looks at the difference between the book value and what you sold it for, so $8,000 in its book value, and then says fine, I got to pay the taxes back on it. So there's a slight sign error here. I'm going to make sure that I do this one right. Oh, here it is, slight sign error here, because this one is supposed to be a positive number. Glad that was gone ahead and checked. There we go. All right, and so the gains tax is the only one that has this within the cash flow statement that has like the opposite interpretation. Usually in a cash flow statement, positive numbers mean cash flowing in, negative numbers mean cash flowing out. Not so for the gains tax. It has like the traditional interpretation that a tax is a bad thing. And that's why when you go down here, where'd it go? Come on. that I've gone ahead and subtracted out the number for the gains tax rather than just adding it up together. So when we calculate our net cash flows, which is just the sum of all those things in the cash flow statement, remembering that there's the opposite sign convention on the gains tax, we find in the first year we have net cash outflow of $9,200. Then, because of the tax savings from depreciation, we have net cash inflow of $2,800. And then the year that we sell it, we have net cash inflow of $7,100 and $7,104 coming back in. And that's even taking into account this gains tax that we had to pay because we sold the asset for more than its book value. Well, if you make the present worth calculation on that, which is what I've done here, you end up with a negative present worth. So buying this asset isn't such a good idea. You're better off not purchasing it because its present worth is negative. So that's the quick explainer for essential question number 4, version 3 in spring of 2011.